Mining is not the bonanza it used to be, at least according to PricewaterhouseCoopers survey. It found miners took a big hit last year, with the combined profits of the top 40 companies plummeting more than 70%. Mining companies are trying to adjust to a post-boom world, with the days of record prices behind them. Scott Alley reports.
Mining is still very profitable, but adjusting to slowing demand and increased supply is hitting the bottom line.
The industry has had a rough year. No one's really been immune to the market conditions. Lower prices, higher costs, big write-downs.
A new report reveals the world's top 40 miners suffered a 72% profit hit last year, generating around $20 billion, the lowest figure in a decade. Iron ore prices held up in 2013, but began a downward spiral to under $100 a tonne this year. And prices for metallurgical coal, used for iron and steel production, and thermal coal, burnt for power generation, have come off 20 to 30% over the past 12 months.
Both markets are under enormous price pressure at the moment. We're basically at or below the marginal cost of production for both thermal and met coal.
2 years ago, Australian coal producers were pouring billions of dollars into new mines. Now they're cutting jobs and putting projects on hold, and there could be worse to come.
There'll be a big shakeout. A lot of the new capacity that is talked about, is planned, won't happen.
Professor Ross Garnaut is forecasting a drop in coal consumption by China as the world's second biggest economy seeks to tackle disastrous pollution problems with big changes in policy.
The Chinese story has many parts. The first part is the push for a different model of economic growth, a different pattern of growth, less investment, more consumption, more services. Now that's good for Australia in other ways, but it's not good for coal.
And with prospects of only modest global growth for commodities, companies are faced with a dilemma over dividends.
Something will have to give, whether it's shareholders' expectations, whether it's increased performance, whether it's some sort of corporate activity. But it's very clear that 2013 will probably sit as a high watermark in terms of the industry's ability to pay out that sort of yield versus its financial performance.
Under pressure, miners will have to dig a lot deeper to please investors.